What is going on, crypto fam? Welcome back to Bitcoin Bulletin, your ultimate source for the pulse of the digital asset world. We are in a constant state of motion, and today is no different. Get ready for a rapid-fire update that you absolutely cannot afford to miss, because the landscape is shifting, and we've got the inside scoop on what's happening right now. From predictions that keep missing the mark to the fundamental shifts in how we understand market cycles, and the latest on institutional plays that are shaking up the entire ecosystem, this is the episode that will keep you ahead of the curve. You're about to get the unmissable updates that are defining the next moves in this incredibly dynamic space. Let's dive straight in. First up, we're looking at the persistent critics of Bitcoin and how their predictions are consistently being defied by the asset's relentless rise. It's a fascinating narrative of skepticism versus reality, and the numbers are truly eye-opening. We'll break down who's been calling it wrong, how often, and what it means for the market's perception. Then, we're shifting gears to a deeper analysis of Bitcoin's market cycles. Forget what you thought you knew, because new insights suggest that the traditional 4-year halving cycle might not be the sole driver of price action anymore. We're talking about adoption, structural shifts, and how Bitcoin is maturing into a complex asset. This is a must-watch for anyone trying to understand the long-term trajectory. Next, we're tracking the big money as Bitcoin ETFs see a significant turnaround after a period of outflows. After days of investors pulling out, there's been a massive influx of capital, signaling a potential shift in sentiment. We'll dissect which ETFs are leading the charge and what this means for market confidence. And finally, we're diving into the technicals with a look at Bitcoin's 100-day exponential moving average. This key indicator is often a critical point for risk management and identifying strategic entry points. We'll explore what it signals for traders and investors navigating the current market. Stick around, you won't want to miss a second of this. And if you're new here, make sure to hit that subscribe button, ring the notification bell, and smash that like button so you never miss an update. The critics keep falling silent. Few figures in the financial world are as consistently vocal about Bitcoin's impending doom as Peter Schiff. With a track record of 18 declared death predictions for the cryptocurrency, Schiff has become a central character in the ongoing narrative surrounding Bitcoin's viability. His latest forecast, issued in April, ominously pointed to a potential 2025 financial crisis as the harbinger of Bitcoin's end. However, in a twist that has become almost predictable, Bitcoin has defied this prediction, surging by a remarkable 40% since Schiff's pronouncement. This pattern of his bearish outlooks being met with bullish price action is not new, and it positions him as a leading figure on the somewhat morbidly humorous Bitcoin obituary list. This list, affectionately or ironically dubbed the Hall of Fame, meticulously documents every instance prominent individuals have declared Bitcoin finished. Schiff's dominance on this list, leading with 18 predictions, highlights the persistent skepticism that has surrounded Bitcoin since its inception. Yet paradoxically, Schiff's own economic teachings and constant commentary, while intended to warn against Bitcoin, have often served to inadvertently drive interest and investment into the asset. He himself acknowledged this unintended consequence earlier this year, a testament to the complex and often contradictory ways the market reacts to public discourse. The Bitcoin obituary list is a broader reflection of the polarized views within the financial community. It includes a diverse array of critics, from Nobel laureate economists like Paul Krugman to other prominent figures such as Nouriel Roubini, and respected business leaders like Warren Buffett and Jamie Dimon. Collectively, these individuals represent 431 death predictions for Bitcoin, underscoring the deep divisions on whether the digital asset is a revolutionary financial innovation or a speculative bubble waiting to burst. Schiff's frequent appearances and pronouncements, often centered on macroeconomic anxieties, provide a lens through which to view the broader market sentiment. His recent discussions have focused on the strength of the US dollar, the specter of inflation, and the potential economic ramifications of specific government policies. These macroeconomic concerns, while valid in their own right, often intersect with the performance of cryptocurrencies, suggesting that Bitcoin's trajectory is increasingly influenced by traditional financial forces. While Schiff's predictions of Bitcoin's demise have yet to materialize, his continued vocal opposition and prominent position on the obituary list serve as a constant reminder of the ongoing debate surrounding Bitcoin's place in the global financial system. As the cryptocurrency navigates its inherent volatility, the market remains divided, contemplating whether Bitcoin will ultimately cement its status as a foundational element of decentralized finance or remain a highly speculative, albeit resilient, asset. His critiques, while persistent, seem to be having the opposite effect of what he intends, creating a fascinating dynamic where skepticism inadvertently fuels adoption. But is the market's reaction to predictions the only story? Stay tuned as we uncover how the very cycles we thought we understood are being redefined. We'll explore how Bitcoin's maturation is challenging the long-held beliefs about its market cycles. Having myth shattered, Bitcoin's new era. For years, the narrative surrounding Bitcoin's price movements has been inextricably linked to its halving events. These programmed reductions in the block reward for miners, occurring roughly every 4 years, have been widely believed to be the primary catalysts for Bitcoin's bull and bear market cycles. However, a recent analysis by prominent analyst James Schiff is challenging this deeply ingrained assumption. Schiff argues that Bitcoin's market cycles are not, in fact, anchored to these halving events. Instead, he posits that the true drivers of Bitcoin's price action are the broader dynamics of adoption and significant structural shifts within the market itself. This perspective suggests a fundamental evolution in how Bitcoin operates, moving beyond its initial, more simplistic supply-driven mechanics. Schiff has meticulously divided Bitcoin's history into 3 distinct phases, each representing a different stage of its development and market integration. The first phase, from 2011 to 2018, he labels the adoption cycle, characterized by the early influx of retail investors and the initial exploration of the cryptocurrency's potential. This was followed by an adolescence cycle, from 2018 to 2022, a period marked by increased speculative activity, leverage, and greater volatility as the market matured. We are now, according to Schiff, in the current maturity cycle, which began in 2022 and is defined by the burgeoning participation of institutional investors and a noticeable trend towards greater stability. He points to major market transitions, such as the 2017 peak and the 2022 downturn, as events that were more closely correlated with shifts in adoption patterns and market structure than with the timing of any specific halving. This analysis directly contrasts with the long-standing theory that halvings create supply shocks, inevitably leading to significant price surges in the subsequent year. Historically, Bitcoin's bull market peaks have indeed occurred in the years following halvings in 2013, 2017, and 2021. However, as Bitcoin becomes more integrated into the global financial system, the influence of macroeconomic factors and large-scale institutional involvement is growing exponentially. These forces are increasingly shaping Bitcoin's price trajectory, potentially overshadowing the impact of its programmed supply reductions. Schiff's argument is that Bitcoin is now behaving more like a mature asset, akin to gold, with its value potentially influenced more by global economic trends and liquidity than by the predictable, algorithmic constraints on its supply. Other experts in the cryptocurrency space are also beginning to question the primacy of the 4-year cycle. For instance, Matthew Haugen of Bitwise has suggested that while the cycle might not be officially over until positive returns are seen in 2026, the trend is shifting towards longer, more extended bull markets. Meanwhile, figures like TechDev emphasize the increasing importance of macroeconomic indicators, such as dollar liquidity and the flow of capital into Bitcoin ETFs, as key determinants of price action. This suggests a paradigm shift where Bitcoin is no longer an isolated phenomenon, but an integral part of the broader financial ecosystem, subject to the same macro forces that affect traditional assets. Blockchain analytics firm Glassnode has also observed signs that the market might be entering a late-cycle phase, noting elevated selling pressure and profit-taking activities. This indicates that while cycles may persist, their nature is evolving. Position trader Bob Laukas supports this view, suggesting that the concept of a cycle-free Bitcoin market is a myth, but acknowledging that each cycle's characteristics are shaped by the changing landscape of market conditions and participant behavior. The upcoming halving in March 2028, when the block reward will decrease from 3.125 BTC to 1.5625 BTC, is anticipated by some to trigger another bull run. However, others caution that macroeconomic factors, such as global debt levels and liquidity trends, could significantly influence Bitcoin's price, potentially overriding the effects of the halving. The looming $33 trillion refinancing wall in 2026, for example, could drain liquidity and put pressure on risk-on assets, including Bitcoin, irrespective of its internal supply dynamics. So, if cycles aren't just about the halving, what's really moving the markets? Let's talk about the real money. We're turning our attention to the significant inflows into Bitcoin ETFs, marking a major turnaround after a period of heavy outflows. This could signal a crucial shift in institutional sentiment. ETFs reverse course, $219 million inflow signals market shift. After a concerning period of significant outflows, Bitcoin exchange-traded funds, ETFs, have experienced a dramatic turnaround, attracting $219 million in a single day. This substantial inflow marks a crucial reversal after 6 consecutive days where investors, particularly institutional players, withdrew over $1.2 billion from these products. The previous outflows had painted a picture of widespread nervousness within the crypto market, but this sudden influx suggests a potential shift in sentiment, with dip buyers seemingly re-entering the market. The rebound was notably led by major players in the ETF space. Fidelity saw inflows of $65.56 million, BlackRock attracted $63.38 million, and ARK Invest brought in $61.21 million. These figures are particularly striking following a period of what was described as a rout, indicating that significant capital is once again flowing into these vehicles. This event is more than just a financial statistic. It reflects a palpable change in market perception, seemingly influenced by recent macroeconomic commentary. Indeed, just a day prior, the market was dominated by fear, as indicated by the Crypto Fear and Greed Index. However, following a speech perceived as accommodating from Federal Reserve Chairman Jerome Powell, market sentiment dramatically shifted. The Crypto Fear and Greed Index subsequently climbed to a greed level of 60, illustrating the rapid change in investor psychology. This turnaround occurred shortly after an 11% correction in Bitcoin's price, which saw it dip to $111,636 from its all-time high of $124,128. While some interpret this as a simple technical rebound, others view it as a strategic opportunity being seized by astute market participants. The underlying reality appears to be that the same large-scale investors continue to exert significant influence over market movements. The crypto market, known for its emotional volatility, is particularly sensitive to such shifts. The $219 million inflow, while substantial in the context of recent outflows, is enough to create the impression of a strong comeback. However, the signals remain mixed, suggesting that underlying uncertainties persist. In a related development, Ethereum ETFs have demonstrated even stronger momentum, capturing $444 million in inflows on the same day, with BlackRock alone accounting for $315 million. This highlights a growing competition between the two flagship cryptocurrencies for investor capital. While Bitcoin is working to regain its footing, Ethereum appears to be attracting investors with the promise of utility and yield through staking. This raises a fundamental question about the long-term capital allocation in the crypto space. Is the focus shifting from Bitcoin's store of value narrative to Ethereum's potential for active use and returns? The data suggests that Ethereum is carving out its own path, achieving capitalization milestones faster than even tech giants like Apple or Bitcoin itself. This influx into ETFs is a clear indicator of institutional interest, but what about the technical underpinnings guiding smart money? We're about to dive into a key indicator. We'll examine Bitcoin's 100-day exponential moving average, a critical inflection point for risk management and strategic entry. Bitcoin's 100-day EMA, a crucial crossroads for traders. In the dynamic world of cryptocurrency trading, identifying key technical indicators can provide crucial insights into potential market movements and inform strategic decision-making. One such pivotal indicator currently under scrutiny is Bitcoin's 100-day exponential moving average, EMA. This metric, which gives greater weight to more recent price data, serves as a vital tool for risk management and pinpointing opportune moments for entry or exit. The 100-day EMA is often watched by traders and analysts as a significant trend indicator. When Bitcoin's price is trading above this moving average, it typically signals an uptrend and can be interpreted as a bullish sign. Conversely, a price falling below the 100-day EMA often suggests a downtrend or a potential shift in momentum, prompting caution. The proximity of the price to this line can indicate the strength of the current trend and highlight potential support or resistance levels. For investors and traders, understanding the implications of Bitcoin's position relative to its 100-day EMA is paramount. A sustained period above this average can reinforce confidence in the asset's upward trajectory, encouraging longer-term holding strategies or strategic additions to positions. However, a break below this critical level can serve as an early warning sign, prompting a reassessment of risk exposure and potentially leading to adjustments in trading strategies, such as taking profits or reducing exposure to mitigate potential losses. Analysts often look for confluence with other technical indicators to confirm signals from the 100-day EMA. For example, if Bitcoin's price breaks below the 100-day EMA and is also accompanied by increasing selling volume and bearish divergence on indicators like the Relative Strength Index, RSI, it strengthens the case for a potential downtrend. Conversely, if the price finds support at the 100-day EMA and bounces back, especially with increasing buying volume, it can signal a continuation of the bullish trend. The significance of the 100-day EMA is further amplified in periods of high market volatility, where price swings can be dramatic. It provides a more smoothed-out view of the trend compared to shorter-term moving averages, helping traders to filter out short-term noise and focus on the underlying market direction. For those employing swing trading or position trading strategies, the 100-day EMA can be a cornerstone of their technical analysis framework. As the market navigates current conditions, keeping a close eye on Bitcoin's interaction with its 100-day EMA is essential. It represents a key battleground where short-term fluctuations meet longer-term trend forces, offering valuable insights for anyone looking to manage risk effectively and identify strategic entry points in the ever-evolving cryptocurrency landscape. And that wraps up our deep dives for today. But before you go, let's hit you with a quick recap of all the massive stories we covered. That's a wrap on another packed episode of Bitcoin Bulletin. We saw critics get it wrong again as Bitcoin keeps rising, explored how market cycles are evolving beyond the halving myth, witnessed a massive $219 million inflow into Bitcoin ETFs, signaling a potential shift, and analyzed the critical 100-day EMA for strategic trading. Don't miss out on any of these crucial updates. Make sure to hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto insights, ring that notification bell so you're always the first to know, and share this video with anyone who needs to stay informed. Plus, follow us on all our social channels for even more real-time updates. Until next time, stay informed and stay invested.